Research at William O'Neill is with us. Mayuresh, thank you for joining in. I want to talk to you about a large mid-cap stock, which was once the market darling, Tata Elxsi. We all know numbers today disappointed. But any sort of wider view on this? It's cooled off significantly. I was looking at the, two-year highs. I mean, the stock was quoting above 10,000 at one point in time. It was a much-loved play in a lot of portfolios. But quite a lot seems to have changed since then. Your view?
Afternoon, Surbhi. No, you're absolutely right. I think from the peaks a few months back, it has corrected quite significantly. And the numbers that came in yesterday were soft. So there is no two ways about it. So the expectations of market participants in terms of recovery, specifically in the R&D space within the mid-cap IT companies, I think this is one hot space where a lot of analysts are of the belief that as mobility picks up quite significantly, and as the content per car starts going higher across geographies, companies like Tata Elxsi should probably benefit. But I think the numbers have been soft, and that's the kind of reaction that you're probably seeing. The other end of the spectrum, Surbhi, its peer, KPIT Tech as an example, has done exceedingly well. Now, if you go by every passing quarter and the commentary thereof, numbers seem very, very encouraging. The kind of tie-ups that they've done, the order book that they're setting out of, the management confidence that they allude out of in terms of the margin performance itself, and expectations of maintaining this over the next few quarters is probably justifying the premium valuations and the move that KPIT and the outperformance thereof with Tata Elxsi as well. So to a certain extent, I think ER&D, the space, I think two spectrums that we're probably seeing. Tata Elxsi is clearly disappointing in terms of numbers expectations. KPIT is probably satisfying, at least till last quarter. How the numbers stack up is probably happening. So I think pick and choose, I think, at this juncture. But KPIT valuations on the higher side and momentum is a little bit too much for comfort.
Okay, all right. Hi, Mayuresh. Good afternoon. What about Aegis Logistics? Do you track that company? The stock is seeing a big move. I understand flows as well are quite strong. It's moved to the high point of the day. Any view out there?
Afternoon, Nigel. In fact, I'm just going through that in the morning itself, and both their divisions have done surprisingly well 9 months FY24. So their gas division and their liquid division have posted the highest EBITDA in the company's history. Again, the expansion plans, Nigel, that they're going through, specifically, I think the liquid storage, if I'm not mistaken, they'll come close to around 1.95 million kiloliters, as well as the gas division, which they're probably expanding in both Pipavav and Bangalore, close to 125,000 metric tons. I think all these capacities, as they start coming on stream, and the expectations in terms of the sourcing that they also do, in terms of their gas requirements, the margin profile is expected to remain extremely stable. Now, with more capacities coming up and the incremental capacities, which will start adding to the overall volume growth in the next few quarters, I think that should drive strong, profitable growth as well across the divisions. So both liquids and gas should probably have that. And therefore, I think the entire perspective that one brings out in terms of EPS growth should be pretty solid. So yeah, I think the move is probably getting backed by numbers at this juncture.
Do you see Q4 pointing towards any recovery? And what's your current weight on it? I mean, allocation weight to FMCG?
No, we are neutral, Surbhi, and I think the reasoning is pretty simple. Our belief is that numbers across the space, albeit one or two instances which might be outliers, will still be soft. A large part of the volume growth on the FMCG market comes from rural India. And rural India is clearly struggling at this juncture. You had seen deficient monsoons last year. The discretionary spending has come down. And therefore, a huge bulk in terms of rural discretionary spending will reflect in lower volumes. Now, is there a genuine recovery that one expects? Again, it's a twofold answer. One, I think in expectations of a normalized monsoon this time around, if that takes place and fingers crossed it does, you will see a good sharp recovery happening in terms of rural incomes in the second half of this calendar year. And therefore, an earnest recovery from Q2, Q3 onwards for a whole host of FMCG companies. The other aspect, obviously, is that volumes have also remained tepid in terms of either increased grammage that these companies have done. And in spite of input cost increases, which have now stabilized to a certain extent, the pass-through was not very, very evident. So both volume and value is something which will be lagging in most FMCG companies. Valuations are sky high. Again, it's a defensive sector when market becomes volatile. But our take is Q1 onwards, I think you will see some element of positive commentary leading to a better re-rating in the second half.
The numbers ain't expected to be good, and the intraday drop is telling you that as well. How do you expect the stock to perform?
I think we'll have to wait and watch for numbers, Nigel, to be very honest. And the expectation largely for the industry as a whole is utilization levels expected to pick up in the coming few quarters. A large element in terms of input costs have largely stabilized at this juncture. You have sporadically heard of some price hikes that have been taken in some key regions. And therefore, the expectations of an improvement in terms of the reported EBITDA per ton across the space is something that is to be watched out for. Obviously, the stocks that we have got on our watch list within the Adani pack, ACC is something that we believe can report a decent set of numbers. And JK Cement within the mid-cap cement space, where the white cement realization should be better off. Numbers have been extremely good so far in terms of both margin performance and an absolute EBITDA. And that performance should continue. So I think we're being a little bit more choosy here, Nigel. ACC from the large cap, mid-cap space, JK Cement.
Okay, all right. Mayuresh, thanks very much for being with us today. Appreciate you giving us all that perspective.